Now, as the concern over Greece worsens, investors are generally demanding higher interest rates on investment products like bank bonds and mortgage bonds. Robert Plehn is the head of securitisation at Lloyds Bank in London. He oversees the writing of corporate bonds, including mortgage bonds. Robert Plehn, thanks for joining us.
Hi, Sue.
Now, firstly, Robert Plehn, of course, we saw a meltdown in mortgage bonds lead to the global financial crisis. What impact has the European debt crisis had on demand for these sort of investment products?
I think you're seeing, Sue, that you have to remember that pre-crisis there was a distinction between the U.S. subprime product and the other securitization product, whether it was European or Australian. And what you found is the latter has performed quite well. What we're seeing in the European debt crisis is that from a relative perspective, again, the product is performing quite well. While you see certain markets shutting down, volatility in prices of certain products, the securitization product has been relatively stable. It's performed from a credit perspective, and it's actually outperformed from a secondary market perspective. So again, relatively a pretty good story.
But are investors demanding higher interest rates to buy, for instance, mortgage bonds?
In some instances, it's actually lower because what they're saying is if they buy a mortgage-backed bond, they can see exactly what they're buying, whereas if they buy a bank bond or even a sovereign government debt instrument, they're not quite sure what they're getting because there's so many unknowns. When you're buying an asset-backed bond, you actually see the individual assets that are backing your bond, and so you have greater certainty.
Now, we heard last week from Mike Smith, the boss of Australia's ANZ Bank. He said that European money markets were effectively closed to Australian banks. Investors didn't want to buy Australian bank bonds. Is that happening?
I don't think that's right. I mean, I think you are seeing that generally the markets are nervous, and certainly it's not the best time in the world for issuers to hit the debt markets. But for instance, we are in the market with Bank of Queensland with a bond that they're issuing, a securitization bond, both in Aussie dollars but in sterling as well. So clearly the markets are open for certain types of products, and if Australian issuers want to access that market, they're able to.
So perhaps there was a bit of exaggeration there.
Oh, I think it's a fair statement to say that the markets generally are not as vibrant as one would like them to be, and not all issuers and not all products can get to the market. So it's probably a fair statement, but once again, I think for certain products and certain issuers, you can access the market.
Now, as you mentioned, covered bonds, the Australian banks have been selling this more secured type of bond over at least the last 6 months. So what sort of reception have they had?
I think initially it was a bit rocky. The Australians tried to launch into, once again, a very difficult market at the end of last year. But the reception since then has been much better, and what you're seeing is a lot of issuance in the U.S. dollar market, issuance in the European market, and in fact some of the Australians have gone into the sterling covered bond market as well. So I think if you speak to most Australian bank treasurers, they're quite happy with the product right now.
But will it have some impact on interest rates down the track if the Australian banks are having to pay investors higher interest rates to invest in covered bonds?
To the extent that the wholesale funding costs of Australian issuers is going up, and that's not necessarily the case right now, but it is wider than it would have been, say, a year ago, that I suspect that cost will get passed on to the consumer. It's inevitable in any jurisdiction. When a bank's funding costs go up, they're going to have to pass that on to their customer.